Thank you. My name is Emilie Mazzacurati. I'm the founder and CEO of 427 Climate Solutions. I will be the moderator for this panel. We have a very talented set of panelists, and I'm going to ask very few questions and let them speak as much as possible. There's a lot of ground to cover, and it's a really nice segue from the previous panel, since we've just been discussing where are the great opportunities to invest, where are the great needs. Now we're going to talk about how we fund those. Not every investor out there is as forward-thinking as the previous panelists. And so there is a need to create mechanisms and instruments that will help bring private finance to help fund some of those major social and environmental issues. And this is very much what blended finance is about, is leveraging and utilizing public and philanthropic funding to raise and leverage private capital into projects that are generally environmentally beneficial. So let me introduce the panelists, and then this is also a moderated discussion, so we will just proceed without slides. So I will start with Virginie all the way to my left. Virginie Fayolle is senior consultant and the manager of the climate finance practice at Acclimatise. So same company as John Firth, who was here previously. And she's an economist specialized on climate change finance and a trainer on climate finance readiness and Jeff and GCF. To her left, we have Stephen Morel, who's an energy specialist at the Overseas Private Investment Corporation, OPIC. And Stephen is specialized on renewable projects as well as geothermal and PPPs. We'll hear more about that. Then we have Joan Larrea, who is the Chief Executive Officer at Convergence. And previously she was also at OPIC, where she led OPIC's efforts to work with philanthropic and private partners to bring capital to emerging market. And I will give each of them a chance to tell you more about what they currently do, because they will do that better than I would. And Joan was also previously the Managing Director at Jeff on emerging markets for energy, environmental, and natural resources. Last but not least, Stacy, to my left, is the CEO and funding partner of Climate Finance Advisors. And she was previously the head of IFC's blended finance unit and represented IFC on many multilateral, that's the end of the day, climate fund boards, including Jeff, GCF, and so forth and so on. So a depth and diversity of expertise. Really look forward to hearing from the panel. I would like to open with just a simple question, give you a chance to present your organization, what you currently do, and with regard to blended finance and adaptation.
It's on. Got it. There you go. So hi, I'm Stacy Swann. I'm CEO of Climate Finance Advisors. We are a consulting firm here in Washington, D.C. Our mission is to facilitate the acceleration of sustainable climate-smart investment. And we do that through integrating climate considerations into our clients' projects, their strategies, their products, their services. We are a collection of people that come mostly from the development finance space, and our background is mostly project finance, banking, structuring, and fund management. And when I say fund management in the context of development finance, that usually means some kind of blended finance approach, and we'll get to what blended finance means in a minute. But we use those skills and that experience to really work with our clients to understand how they can structure and finance climate-smart solutions, both on the mitigation side, but also on the adaptation and resilience side. And in that space, there's a lot of work that we do with our clients to think about risk and resilience. And I'll stop there.
Hi, I'm feeling very cozy because I'm sitting between an old friend from OPIC and an old friend from IFC. And our name is Convergence Blended Finance, and we're on a blended finance panel. So I feel like this, if we can't handle this one, I shouldn't be here. So really excited to be here, and thank you for the invitation. Convergence is an institution that was set up to educate, connect, and support other institutions who are out there trying to do blended finance transactions in the emerging markets. So we are not climate specific. We're actually sector agnostic. Any deal in the emerging markets that supports the attainment of the Sustainable Development Goals is in our wheelhouse. So educate, support, and connect. Essentially, we do three pretty simple things, all in the name of helping other people get transactions concluded that have blended finance elements. First of all, we have a grant window where we support work on very early stage, proof of concept stage structures that might be breakthrough structures or at-scale structures in the blended finance space. Secondly, for deals that are well advanced and in fundraising mode, we actually have a matchmaking site, the Investment Network, where if those deals meet our criteria, they can be posted, and institutional investors, including development banks, aid agencies, philanthropics, and straight capital providers, the Citibanks of the world or the Abraj Capitals of the world, can look at those transactions and see if they're of interest to them. We also are there to promote the building out of the blended finance field, because there's not a lot of data or evidence out there about whether it works or not, what kinds of structures work, who's done deals in blended finance. And so we write case studies. We have a historical deal database which shows what's been done in the field. And we run seminars, whatever we can do to help people, help reduce the deal friction on your way to closing a transaction. So that's essentially what we do, and I can speak about any of those points a little bit more as we go.
Great, thank you. For those of you not familiar, the Overseas Private Investment Corporation is the U.S. government's development finance institution. And so very much like the private sector operations of the MDBs, OPIC provides certain financial products to help accelerate investment in the developing world. And there's kind of two key mandates to that. I'll call them 1A and 1B because they are fairly equal. 1A is to help accelerate U.S. business investment in the developing world. And so we always target U.S. investors that are interested in either investing capital or putting in their services into projects internationally. And 1B I'll call 1B for development purposes, that we look to support projects and companies that are helping develop in emerging markets. And that includes a variety of sectors. And so one of the things that affects our work that we see on a daily basis, which is why we find ourselves participating in panels such as this, is risk, as we've heard this morning, is kind of a feature of any investment. And resilience has been a risk to our investors, and therefore OPIC is involved. And it's key to our interests. And so, very excited to be here. I was actually just saying, and then I'll stop, but I was just saying I'm excited to be here because I think this panel is kind of ahead of our time. I'm just getting introduced to the concept of blended finance in the developing world overall for any kind of development project, not just climate related. And so it's nice to have a very specific climate related panel on blended finance.
Okay, thank you. So I'm Virginie Fayolle from Acclimatise. I lead the climate finance practice area of Acclimatise, and my background and kind of expertise is a bit different from the other panelists because I'm not involved in the transaction side or deal side of blended finance. My role at Acclimatise is more like supporting regional agencies, national government, and also local businesses in developing countries to access global climate finance, and mostly at the moment focus on the Green Climate Fund. But it involves also advising them in terms of how to leverage private sector investment and how they get their local businesses and companies on board to implement the national priorities. So clearly I'm more focused on the resilience and adaptation side. And it's really like a kind of core focus, like working mostly in least developed countries, smaller and developing states that are very vulnerable to climate change and are more in need of adaptation finance, and where actually getting private sector on board is more of a challenge because of the lack of maturity of the financial market. So that's the sort of issue we're dealing with every day in our work at Acclimatise. Yeah.
Great, thank you. And Virginie, please keep the mic because I want to give you a chance to speak first to this very question, starting with where is the need and why do we look at blended finance? Why is blended finance something useful in the context of climate adaptation?
Okay, thank you. Blended finance is nothing new. I mean, it's been bit of a buzzword in the context of climate change right now, but it's been used by multilateral development banks for ages, for some time, to to blend concessional funding with commercial funding and catalyze private sector investment. So that's why blended finance has been, ongoing for some time. So nothing new here, but in the context of the international climate finance landscape, it's really the interest is, of the discussion is how blended finance can be used to leverage more funding to meet the needs of developing countries in the context of the climate change needs, and in particular addressing the adverse impacts of climate change. So developing countries have been committing to mobilize $100 billion per year by 2020. We know this is peanuts. We know this is very little money, and it's not clear how this money is going to be mobilized, how much is going to come from public versus private sector, and so on. But the real issue is that, there's clearly need for a lot of funding. Public finance is not enough. So that's where blended finance comes in the context of the climate finance debate. However, raising the money is only half of the battle. And the real challenge is actually most of the private sector finance at the international level is going towards mitigation at the moment, towards large-scale energy project, renewable energy. So we've been, using blended finance in terms of mitigation project for some time. So, and we know that most of this private sector finance is going towards that. And adaptation lags far behind. So a real challenge, and the other battle is actually our adaptation, how blended finance can be used towards adaptation. And the real kind of like refined details is like how this money is going to go to the right places for the right things. And when you compare a solar project in a large-scale solar project in Chile, and then a small off-grid project in rural Bangladesh, where 30% of the population doesn't have access to the grid, doesn't have access to electricity. The needs are clearly different. The investment needs and the scale of the investment is clearly different. The type of investors are also very different. So it's more thinking how we can, pilot and develop innovative models to channel those resources towards where adaptation finance is needed. And we know that adaptation finance is needed in the more vulnerable countries, so clearly least developed countries, African countries, and smaller land developing states, where private sector is not maybe as developed, where financial markets are not clearly not as mature as in middle income countries, where IFC has been kind of doing a lot of blended finance projects and deals there. So the issue is more like how to get the money to the right place for the right things, and what are the innovative models that can be used to catalyze private sector investment, including from domestic private sector towards those adaptation projects and investments and needs.
Great, thank you very much. And we will talk more about those innovative models, but essentially I heard blended finance is a great way to help direct money towards specific projects, locations, and sectors that maybe would not otherwise see interest from the private sector. So I want to turn to Stacy and ask you, surely this kind of project is not for the faint of heart. There must be certain type of investors that are better suited to this approach. And also in practice, how does it work? What are the instruments or the mechanisms that you use to bring very different investors together?
Right, so that's a number of different questions in two questions. Let me start with kind of my experience at IFC, since we brought up the context of IFC and blended finance in that context. And let me also start by saying it isn't new. It actually is not new at all. Governments have been incentivizing investment in sectors where they see a need to catalyze investment forever. With tax subsidies, with other kinds of incentives, with grants, with innovation programs, things like that. Blended finance is a little bit of a term of art these days. In the context of the development finance world, and climate finance, it's really come to be defined by using public dollars, often from climate finance sources, to catalyze investments that the institution managing those dollars wouldn't be able to do on its own for a whole host of reasons. So it's really about taking the step just beyond market, what the market would do on its own. And of course, the markets are different, risk appetites are different. The risk profile of a project changes, and markets change. So it's about doing this kind of blending, taking the public dollars to incentivize the private investment at a point in time to make a project happen that wouldn't otherwise happen at that point in time. And there have been a couple of really good case studies where it really was about something that was some market imperfection at the point in time that the project needed to be invested in. And I'll just, because I'm here at IDB, one of the kind of examples that jumps to mind is a wind project in Mexico that was financed roughly around 2009, 2010, with IDB money, with IFC money, with XM money. I think OPIC was also in the deal, and some clean technology fund money that was subordinated at a lower price for the risk-adjusted cost that subordinated tranche should have taken had it been priced to the market. And why was that needed then? It was needed then at that point in time because all of the financiers fled that project after the financial crisis. The project had been under development for a couple of years. It had private finance around the table until 2008 when everybody pulled back. And they didn't pull back because the project was not good. They pulled back because all kinds of other things put all kinds of pressures on their own internal process. And the decision was made by the international finance community and the development finance community that wasn't a good enough reason to stop the project for however long it would have taken for the markets to recover and the investors to come back. That particular project in Mexico was it had a high demonstration effect because not only did it get the project going, but future wind farms in that part of Mexico had no concessional finance involved. Auctions were oversubscribed. What it did is it not just demonstrated the financial viability, but the regulatory framework that those projects in that area sat on at that point in time. Nobody knew how that was going to play out over the course of a couple of years. So that's a kind of very detailed example of how you can use some concessional money to blend and catalyze something. But my point was more that it's really about the kind of solving for that imperfection at a snapshot in time because it will change. Markets will change, appetites will change, technologies will become more, the risk associated with technologies will go down, and that has an effect on moving projects out of blended finance into market-based finance. So going to the instruments, when I think of blended finance, certainly in the development context, it's really about taking those public dollars and structuring it in as debt, as equity, as guarantees, as some kind of risk mitigating part of the financial structure to enable that project to happen. But that's project finance. There's also ways to think about blended finance for bonds, for securities, for catalyzing institutional investors. A number of funds have been put together or structured with C shares or a portion of the fund being taken by a more patient type of finance, whether it's public money or philanthropic money. And that is, in its own way, blending kind of public patient capital to catalyze, crowd in institutional investors. So the blended finance kind of can be applied in a number of different ways. And I'll stop there.
All right, we'll go back to the stakeholders later. So I want to turn to Stephen. You're in the weeds, you're doing those projects. What are the challenges that you encounter and what are ways to overcome those challenges when it comes to blended finance?
Yeah, no, it's a good question because I think if blended finance didn't have its problems, then we would be using it en masse to solve some of these resilience issues and generally implementing a low carbon economy. And so I think what may be helpful to start with is to reflect a little on kind of a very basic issue that I think we heard about earlier, that really private investors have a fiduciary responsibility that requires them to seek optimal risk-adjusted returns on any of their investments, regardless of what it is. And at present, in the absence of stable policy frameworks, in the absence of international finance tools that help mitigate high levels of risk, then those investment opportunities just don't pass the test. And so private investment can really only flow at scale and pace if it's supported by kind of clear, credible investment frameworks that shift that risk-reward balance. And so to see that in action at an institution like OPIC or any of the MDBs, kind of blended finance offers institutions that mechanism to address that imbalance. And I think we heard a little about that, which has been wildly productive in many infrastructure asset classes and mitigation in particular. But there's still really kind of 5 significant challenges that I would highlight that limit private capital from scaling up resilience in developing markets, which is kind of the markets that I focus on. One is that returns are still seen as too low for the level of real or perceived risk. I think that that's a big issue that we've dealt with talked about a little this morning, but we'll continue to deal with. Local markets don't often function efficiently, as we know, with local financial markets in particular, and developing economies are particularly weak. And then issues, of course, with private investors as well. Private investors have really knowledge and capability gaps, which impede their understanding of investment opportunities in kind of this area and unfamiliar geographies as well. And private investors also have limited mandates and incentives to really invest in some of these areas and any kind of market with a high development impact, which makes it challenging as well. And then the last thing that I would mention is that kind of local and global investment climates are really challenging for private investors because of poor regulatory legal frameworks and significant political risks that remain. So what we like to see with blended finance are supporting mechanisms that can really help overcome some of these challenges because it's not just easy enough to say, all right, we can provide a concessional element here of financing when you're a market-based financial institution. Even development finance institutions like to get their returns or have a reasonable reassurance of repayment, and so they can't easily just provide free money. And so having supporting mechanisms is really the way, I think, to overcome those barriers. And they really consist of, I'd say, 3 broad categories. Technical assistance, which has been particularly helpful in terms of supplementing capacity of investees into kind of low carbon investments as well as resilient investments. Risk underwriting, which Stacy mentioned can really help fully or partially at least protect investors against risks. And the last is to see more market incentives, really either guaranteed payments, for example, in resilience contingent on performance of future pricing, or payments in exchange for upfront investments in, say, new or distressed markets. Those are going to be really helpful supporting mechanisms to really help overcome some of these challenges that I think we're seeing in blended finance.
Thank you. I wanted to turn to Joan because you're also seeing a lot of those projects, and you may have see additional challenges, especially when it comes to adaptation, but also with blended finance in general.
Sure. So I think climate finance or climate issues lend themselves to blended finance very well because of something I thought was totally useless back in business school in my econ class, which turns out to be really vital to this sector, which is this whole concept of externalities. So climate finance deals generally have 2 components. One is there's some kind of financial return, but there's also an externality of some point. There's some benefit to doing the deal that's accruing to someone, or there's some negative outcome of doing a non-climate smart deal that's happening. So saving the coral reefs is useful, but possibly not to the people who might be asked to invest in it. There's just no financial return, but it's really valuable to somebody. So these transactions have a public good element as well as a financial return. And often it's really hard to capture and monetize the public good element of what you're trying to do in a climate deal and turn that into a cash stream for somebody who has a fiduciary duty to return money to their shareholders. So the more interesting transactions we've seen actually kind of draw a hard line around those externalities and pull them back into the financial equation. And I think that's the cool thing about some of the deals that we have seen. So just to give a couple examples, just to tell some stories. In our design funding early in our grant program, we have awarded a grant to the Nature Conservancy, who has done a deal in the Seychelles, which is kind of a neat deal. Essentially, the government of Seychelles was terribly indebted and also has a strong interest in its coral reefs and its fisheries, but those two things are seemingly disconnected. So the structure that was put in place is essentially a new SPV was created that bought the debt, restructured the debt, did so with a layer of grant capital and also investors in the deal, earning returns that are risk-adjusted now as a senior tier. And in exchange for reshaping the debt profile of the government of Seychelles, this group managed to extract commitments from Seychelles to do certain activities that over time would protect their reefs and designate new fishery zones or protected fishery zones. So you've just captured a public good in a transaction by blending smartly grant funding from people who have a social interest or a climate interest with institutional capital. To give you another example, we just financed, again in our early stage finance window, the Indonesia Tropical Landscapes Facility, which actually is more on the, to Virginie's point, their individual transactions in this facility may end up sometimes being captive biomass projects in agricultural concerns in Indonesia, but the overall objective is to protect land use, or to conserve land by making more efficient use of agricultural land. The idea in the tropical landscapes facilities, essentially you bundle up a number of these transactions and you can float a credit-enhanced bond to institutional investors, which is interesting again because the fiduciary duty issue is met, and you actually get a transaction to scale by bundling up a series of transactions, hopefully. This is all very early stage stuff. But you bundle up a series of transactions that get you to a scale where institutional money can come in and take a bite out of it, but only if it's credit enhanced. So there are a couple of examples where you've got a climate issue and a need for financial return, and somehow the pair must be captured in some kind of financial structure.
Thanks, this is very helpful. So Virginie, you mentioned earlier the need for innovative models when it comes to bringing blended finance to climate adaptation. And I'd like to ask each of you in turn to give us concrete examples, and feel free to go in a little bit of details. We have some time in terms of either pilot projects or past projects, maybe projects in the making, that leverage blended finance to accomplish adaptation objectives.
Thank you, Emilie. So again, I'm not the best person to answer detailed technical question on the kind of financial structuring of project, but from our perspective, Acclimatise is, developing projects. So we develop projects, and one of the projects we develop is actually a project under Proadapt in Jamaica that aims to kind of create a market for adaptation in the water, in the newly built housing sector. So promoting water efficient technologies amongst housing developers and construction companies. And as part of the, so without getting into the details, as part of this is really thinking how to create a demand for those kind of technologies that would promote better water efficiency in those newly built housing. And this includes like providing a concessional loan to the Jamaican Building Society that would on land to housing developers to promote those technologies, but also combine with a technical assistance component that would aim to kind of promote like a business case for how you get a return on those investments, also like training on how to install those new technologies and so on. So this is a kind of example we see. And this technical assistance actually was financed by the Proadapt program. So just a quick example, yeah.
Great. Stephen, do you want to go ahead?
No, thank you. I appreciate it. Unfortunately, Stacy already stole my example, which I always like to give, in terms of the climate investment funds, which do a great job in terms of kind of blending finance with other institutions and in energy projects that I've seen. And as an energy person, kind of my pet projects have always been geothermal power, which I love to work on. Which is a challenging sector in terms of long development timeframes, significantly longer than other renewable energies. And so one of the interesting things that the Climate Technology Fund did in Indonesia was to be able to provide financing that essentially in the technical way that it went through the loan agreements is it had less CPs, less conditions precedent to be able to disperse on the funds than any of the other senior debt. But otherwise, it was actually pari passu with the senior debt in terms of recovery, in terms of rates, and it was very interesting that that was deployed early enough to be able to make effective development, where then equity capital wasn't required that really shot up the cost of capital. And so it brought down the overall cost of capital to the structure of the deal, which I thought was very interesting. And so it's not even all the time being able to provide a concessional rate to a project. Sometimes you have different conditions to be able to get to the deployment of those funds, and that can result in an interesting blended finance structure as well.
The microphones. I could go on with examples all day of interesting things that smart people have done, so I'll just give you another one. Convergence is not formally involved in this one, but I just think it's a really interesting climate transaction for this audience, because one of the differences between climate finance or blended finance for climate and blended finance for anything else is the absolute urgency of moving now. That distinguishes this subject from any other thing we work on. Because we're all on just this one planet, and the clock is ticking. So this one structure that I'll describe is called the RAF, the Red Acceleration Fund, which is being worked on by Encourage Capital and Environmental Defense Fund, among a lot of other folks who are putting in some great work. The challenge they're solving for is there is not yet today a formal market for RED plus carbon credits. These are the credits of preserving essentially the world's last forest, great forests. And you cannot get to below 2 degrees climate change if we don't do 2 or 3 major things. There are 2 or 3 buttons we can push or not push, and we get there or we don't. One is the forests of the Amazon and Indonesia and a couple other places. Secondly, how India and China grow and what kind of power plants they put in place, what course they take. And the other is probably the US. So this fund is approaching the problem of the forests. And what they're saying is, let's structure ourselves as a buyer of RED plus credits in this intervening period where no market exists. And so the clock is ticking and there's no market for these things, so there's no incentive to protect these forests. And what they've done is created a structure in which there's grant money at the table. There are options buyers at the table, because if the market ever does spring forward, somebody holding an option is going to be really happy. So there is actually cash on the table available from options traders today, and investors. And they will go around trying to negotiate to buy credits and essentially warehouse them, waiting for a market to spring forward. At the very worst, those who've put their grant money in will have helped to slow down deforestation by putting money into a vehicle and then into the activities beneath. At its best, this will buy us 5 years of time where there has been some incentive by creating a buyer in the market for, the proper actions to take place to preserve more forests. That's a really heavy lift in terms of structuring and ambition and everything else, but it's great thinking. And so it is possible to do the impossible, which is capture the externalities, provide the financial returns. I think people who are having that kind of creative process should be applauded and supported.
That's fascinating. Thank you. Stacy?
No, I'm glad you brought up the urgency question, Joan, because what I was thinking about as I was listening to this and looking at the title, The Role of Blended Finance in Promoting Climate Resilience, So blended finance, at least in practice in the DFI world, first the sources of capital were climate funds. Although sources of blended finance today include governments, include philanthropy, include some impact investors. So if you kind of put the sources of blended finance in one category as people who are seeking out the impact faster than it would otherwise happen. But the experience of blended finance in most of the developing world or development world in the last 15, 20 years has really been about making projects bankable when they weren't bankable, right? And the thought that was just going through my mind, and we're kind of noodling over this at Climate Finance Advisors, is your project bankable if it's not climate resilient, right? It probably isn't. The bankability of projects and the risk register of projects doesn't currently include climate change or resilience, although there's a lot of people, and we talked a lot this morning about the risk side of things. Sources of blended capital, including the climate funds, including governments, could actually start asking that question to increase the resilience, even if the majority of the funds are going towards energy projects, because that's where the portfolio is right now. If we're pushing them in beyond middle income to low income countries, or frankly just infrastructure, right? But if it incorporates on that risk side of things, that question, that actually has a huge impact. It's slightly nuanced, it's not necessarily resilience, investing in resilience, it's making your project more resilient, as we talked about earlier today, but it's a role that blended finance can play in promoting climate resilience, is really bringing to the surface the fact that we're not accounting for this risk anywhere. Once you account for the risk, then I do think there's a whole opportunity space that opens up for blended finance approaches because we don't have any time. And whether it's infrastructure or water or housing or ports or, we could keep going down the kind of list of sectors that you could apply this to, that's great. But just simply raising it in the risk register of what you're already doing is going to make a huge difference, I think.
Just to piggyback on that thought, because I think that's really important and something that's going to continue to develop as the MDB, as all of the international finance institutions start to develop these more robust tools, like what Acclimatise offers in terms of screening their portfolio and screening their transactions for climate resilience, that it is going to become an important factor to what they consider bankable. And taking energy projects as an example, I have a list of probably 10 items that will be the first thing I look at when I'm looking at a PPA that somebody's signing for an energy project. And if I can't check them, then I'll say we need to work on X, Y, or Z in order to really make this a bankable project. And I think that's going to continue to develop as the portfolios have better screening mechanisms to understand what is the climate risk in individual investment portfolios across the DFIs, across institutional investors as well. That will become a primary question, and I think it's an important one.
Very much so. Any other comments on this? So I have another question, and then I'd like to open it to the room, so I'm giving you the heads up so you can start thinking about your questions. Joan, I wanted to take you up on your offer earlier. You mentioned you had done some research on how well does it work, how do we know? And so I'm curious about both what are the metrics by which you consider a blended finance project successful not just in terms of adaptation, that's everybody's question, but in terms of the purpose of using blended finance in a way?
There is not yet a solid evidence base for blended finance, despite it being much older, as Stacy and Steve had said, than we realize. And part of our job, we're a startup, we've been in existence for a year, so part of our job is trying to lay that evidence base down by capturing everybody's experience. So at its best, blended finance pulls together actors who don't normally work together and produces a transaction that would not have happened without crowding out regular private sector activity. At its worst, blended finance throws soft money at a problem that would have been solved already by smart capitalists and crowds out normal activity and or does not have an impact. So I think as we go about documenting what people have done out there, we will eventually trip over both of those kinds of data sets and we will be able to report back to you. But right now, the data doesn't actually exist that I know of in a solid form.
Well, and I'll just add, having kind of practiced this for quite a bit of time, it is an art and a science, and it is it's forever trying to prove a counterfactual. So that's difficult. A and B, the ability to understand whether something would happen without your concessional money is often something you only glean around a negotiating table, and it is a negotiation. So sometimes you you can understand, you know, there is the kind of is it needed question, and then there's what's the sizing and pricing of what's needed, because the objective is to minimize the amount of embedded subsidy or discount or non-risk adjusted pricing that you're giving. And that is about negotiating and about models, and you know, it's really in the weeds of kind of structuring a deal. And it'll be true kind of when you close the deal, but looking back, there's a lot of room to second guess, because the markets change, appetites change, investors get more bullish, things evolve. So we used to say in IFC, it really is about that snapshot in time. And we have to all be comfortable, and there were a lot of people involved, investment committees and investment officers and managers and all kinds of things. We had to all be very comfortable, hold hand on heart and say, yes, actually, at this point in time, this deal is not bankable without our concessional funding. But for us, we know it wouldn't close. And that was a test that we all had to kind of put ourselves under.
Any additional thoughts, Stephen, Virginie? Okay, so let's turn to the room. Are there any questions at this point on blended finance, finance for adaptation? I know it's the end of the day, yes.
We talked a lot about blended finance for kind of large infrastructure investments, but I was wondering, you know, or actually to take a step back, in the previous panel, we also talked about innovation, and that coming from, you know, small entrepreneurs, sometimes young first-time entrepreneurs. What is the role of blended finance in venture capital to promote these innovative models?
Great question. Please, Virginie, go ahead.
I just can give an example of project I'm aware of. I'm not so familiar with the details, but so the Green Climate Fund has a big focus in terms of developing innovative approaches to blending finance. And one of the first private sector projects approved under the Green Climate Fund was developed by Acumen. I don't know if you heard about them. They developed a project, a venture capital fund actually, in Kenya, never remember the countries, Uganda and Rwanda, to support, I think, 15 or 16 early start kind of enterprises in developing off-grid renewable energy solutions for, you know, low-income households in rural areas, and makes this project, like, you know, basically viable over the long term, you know, and developing the business models for those companies. So, you know, there are examples out there. Again, it's mostly focused on mitigation. So what would be interesting is to understand, you know, is the Green Climate Fund going to look at a similar project with more of an adaptation focus? That's kind of the big challenge, really.
That's a great question, because there is a financial ecosystem problem, right? And particularly in blended finance. A lot of blended finance today from the MDBs and in the kind of space of international finance is looking at big, looking at infrastructure, looking at quote-unquote wholesale approaches or funds, right? And you can do that, and you'll get 8 projects this year, because there will be 8 PPPs for which you need a blended finance tranche, and it might have a big dollar number next to it, and you could say we invested $10 billion, whatever, making numbers up. But that's 8 projects versus hundreds at the lower end, and the Acumen Fund is actually a perfect example of that, because that fund is actually not at the lowest end, right? So what you need to get some of these entrepreneurs kind of out of their early stage growth from like seed to post-seed to Series A is, you know, kind of a lot about bankability, a lot about training them how to kind of grow into being kind of stand up businesses and then grow and scale and all of that stuff. The Acumen Fund, I think it's fantastic that GCF has funded it, but Acumen is let's say, kind of Series A space, not entrepreneur post-seed or post-seed space in that context. And there's a big gap and potentially a huge need for blended finance approaches for those kinds of entrepreneurs, particularly as we heard today, a lot of the solutions are smaller companies. They're not, well, we have to do resilience and infrastructure. It's a huge thing that needs to be done, and a big kind of undertaking. We also have to kind of build up the businesses who are going to serve markets, who are going to provide data and services to clients, to consumers, you know, to things that can enable them to change the way they're consuming, producing, and becoming resilient to the warming that's going to happen, whether it's water or whether it's, you know, health services and applications for health services. Those are not big PPP projects. So we need approaches that are downscale in the financial ecosystem and close to the project. So,
can I inject a note of hope? So some of the prototypes of blended finance that we've observed, there's some sort of standard patterns you see in how it manifests itself. And one is you'll see subordinate capital inside a structure in a capital stack. Sometimes you see a risk mitigation overlay on a structure. Sometimes you see a technical assistance facility alongside the structure. And then sometimes what you see is blended finance operating over a time-lapse photography of the project. So you will see soft capital, grant capital in the project formation, preparation, early stages, seed capital stage, and then as the project continues, whoever was backing it early on says, now go find some hard capital, now go find some real money. And so an observation for which I don't actually have the data, but this is just sort of a pattern I'm seeing, is that you're seeing some private philanthropies act as venture capitalists, but with grant funding at early stages of transactions. And a further anecdotal observation, again, I don't have the stats on this, is that they tend to be the newer generation of philanthropic organizations, you know, the dot-com guys who are trying to find companies that somehow resemble themselves and they feel like they understand and they want to get their hands on it personally. So you do see sort of a use of grant as venture capital in some early and seed stage. My issue with all of that is, great, you know, you've funded one entrepreneur at $3 million and, you know, the glaciers are still melting. So how do you get that activity to be massively scaled? It's great not to just support the big projects, but how do you support the little ones at massive scale? So.
Yeah, that's a big problem. There was another question, please.
Hi, I'm Lad Cannell with Citizens Climate Lobby, and we're promoting a revenue-neutral carbon tax in the United States and carbon markets overseas. My question is actually about partial credit guarantees. USAID has the Development Credit Authority. I don't know if you have any experience with that and if that could be applied to this market. And also insurance, like MEGA of the World Bank Group. So I'd be interested in hearing those. Thank you.
Great, thank you. Any taker on the partial guarantees first, Stephen?
Yeah, no, absolutely. I think you're going to find a really important role that the partial risk guarantees play, and this is kind of what I was mentioning earlier in terms of the support that you can be able to provide with blended finance facilities, whether it comes from TA or risk underwriting overall. DCA provides that. OPIC provides those type of guarantees as well. And I think they're really critical for resilience because you really provide the opportunity to reduce specific risks, you know, associated with a specific transaction. You can either provide kind of direct compensation, assume losses for specific negative events. And so it really actually plays well into this field. And I think it's going to be important going forward. And I think you'll continue to see that through DCA and other organizations as well. And then same with insurance. I think that insurance is going to play an important role. What I would find to be interesting, and I think a lot of organizations are starting to work on this, is to see what kind of sovereign backstops you find behind resilient programs, because the more sovereign backstops you find behind them, the more ability for the political risk market to get involved. that those risks can be completely wrapped by any kind of political risk insurance that's out there, that's both in the private market and DFIs through like MIGA, and OPIC is another example of that as well. And so I think that'd be an interesting dynamic to see. But one thing that you have found in resilience is a burgeoning insurance industry anyway. And they've really wrapped their heads around kind of what it means to provide a guarantee when you're modeling losses from climate events, so that I don't think the DFIs have quite gotten there yet. So I think that's interesting as well.
Yeah, I want to add to the insurance point, because I actually think that there's a lot of really interesting stuff happening in the insurance industry beyond the DFIs, and beyond the MIGAs and the OPICs, and in fact in collaboration with them, because there's a lot of collaboration. Insurance companies are interesting to us because of all of us, they are the most experienced at pricing risk. And the FEMA guy, Nick, I think was his name, was speaking about the unfelt risk of inaction. You know, you scream that something's about to happen and people feel much more comfortable not acting than acting. It feels like it's not making a decision yet, but you just did. So insurance companies are really, really skilled at putting a price tag on the status quo and a price tag on what the risk would be if you actually took an action. And so they introduce healthy pricing into the equation, which is always a great start for structuring any transaction, is to know what the cost is of all the alternatives. And then blended finance can step forward and say, okay, you know, if you need parametric insurance to protect a country against a particular weather risk, and that country can't afford it, perhaps the answer is to start, you know, with a less than commercial solution, and perhaps work your way toward one, or admit that the cost of this climate change in this instance is happening to a group who can't afford it, and it's being caused by someone else. So insurance companies have a lot to offer in structuring, I think, in blended finance for climate.
I just want to give one little antidote on the guarantee question. So there's a lot of debate about the right instruments in blended finance right now, and I think there was an article that came out this morning or yesterday about how really what we need is equity in climate, from climate finance, and not guarantees or debt anymore. The story about guarantees that I'll tell you, a couple of weeks ago I was at the SE for All Forum, and the gentleman from Citibank was on a panel with one of the mayors of a Latin American city, and they were talking about guarantees for energy efficiency, citywide energy efficiency. And the guy from Citibank said, look, you know, I have to kind of, my project has to be bankable without the guarantee. Guarantee is always an addition, right? I'm going to kind of look at the merits of the project and price my product and kind of structure everything. And the guarantee is kind of extra, but not what the project decision stands or falls on. And I thought that was really interesting, kind of a data point from Citibank in Latin America about what they view the value of guarantees as. We are using a lot of climate finance and guarantees these days, I think in part because we believe as a development community that that's efficient and potentially less risky and maybe incentivizes people to do more, but I'm not sure. I think the jury's out. And in particular, we've used a lot of guarantees with financial institutions, and the financial institutions, somebody actually earlier this week articulated that the financial institutions in emerging markets that have these guarantees are constipated and aren't actually getting the actual kind of energy efficiency and renewable investments. Probably it's the same for you know, small scale infrastructure, SME lending, ag. But it's an interesting thing to think critically about whether the guarantee is bang for buck, the best use of this kind of money. And I can tell you from my experience, equity would have been really, really valuable.
Actually, our data support that. We have in our database of historical deals, we have about, I don't know, 200 some deals logged, which is obviously not the universe of blended deals out there, just as a caveat. But of the ones that deal with climate finance in some way, the most capital, if you look at it by amount of capital deployed, guarantees show up very, very heavily as compared with equity or debt or concessional, you know, grants or whatever. So you're absolutely right. The pattern is there that guarantees are heavily deployed. I don't know if they're over deployed, but they are definitely the predominant form of blended finance.
That's a great panel. Jay Coe from GARI and Lightsmith. I think a lot of that probably is related to what the reserve charges you have. You know, it's easier to issue guarantees in equity, and everybody kind of needs to pay attention to that piece of it too. My question is about the affirmative investment piece of adaptation and resilience. So, you know, you talk about guarantees as risk mitigation on existing investments. I mean, everyone's renewable energy projects are vulnerable to climate change right now, and almost none of them are hedged, and almost none of them are designed with climate smart forecasting because no one has that yet. Some people are working on it, but that needs to get done. In part, the way that that's going to happen, I think, is that companies need to get formed or develop that do that. And I'm just wondering, you know, we've been proposing and working with the lab here on proposed growth equity strategy for the first time that would actually try to focus on solving the equity and capacity problem. If there's anything else that's actually out there that's focused specifically on adaptation and resilience, that's an affirmative strategy that's investable, and if blended finance tools can be brought to do that, because you know it's great that this conversation has progressed over the last 2 years, and in no small part because IDB MIF and the Nordic Development Fund have pushed on the private sector and said this is an investable area. I think 2 years ago, even as late as May Paris Climate Week 2015, people were just standing around saying, "Well, there's we need $300 billion from someplace to do what? We're not exactly sure, but we need a lot of it, and we have no idea if the private sector plays a role in it or not." So, is there a landscape out there of emerging strategies to effectively invest affirmatively in adaptation, and is there a role for blended finance in pushing that agenda forward, at least at this stage, before you get to, large-scale project finance land, when we actually know what the large-scale project finance is going to be in adaptation, which I don't think we do yet.
I guess that one falls to me. I have not seen a stream of equity strategies coming forward that have to do with investing in firms who do forecasting or other positive strategies, no. If they did, I'm not sure if they'd need to be blended finance. I would imagine there's a really strong commercial argument for some of these, but I don't know. I have not seen a pattern of that kind of equity strategy.
I'll just nuance. Do you want to go ahead?
Well, I would just say the kind of justification for a blended finance strategy here really is the timing. We have spent 2 years since Paris talking about this, and I see a lot of opportunities springing up, and I see a lot of capital still sitting on the sidelines. That's 2 years we could have been already investing, right? So I think there's a real role from a timing perspective to argue that, and in particular, because we have zero time to waste, really. I mean, Sean Kidney was here. I don't know if he's still here, but he mentioned some article that's coming out next month that says the warming is more kind of extreme than we're expecting. I think we have to get to it fast, at scale, everywhere we can. And if we have to put some blended finance or some concessional money in order to get that going, I think that's well worth it, frankly.
I'll just jump in outside of my moderator role to your question. Having looked and worked on the space a lot, I think we're starting to see a slight fluttering of a few investors who are starting to look at this, and I don't think it's going to be blended finance. I think it's going to be private equity and VC, and which doesn't mean there isn't a need for private finance, but that there is also a private play purely to do in that space. But also that the work that Emilie is doing in Japan on behalf of the government, there is a role for the government in technical assistance or public entities, technical assistance and convening and helping that space emerge and grow and bring people together like this event. But I think we're starting to see some of that. Anyway, I'm going to put my moderator hat back on because we're just on top of the clock. So I just want to give you a chance to say one more thing. I mean, blended finance is about making the business case for adaptation from an investment standpoint. So where would you put your money? What's the sector where you see the greatest needs and that lends itself best to this type of blended finance opportunities? And I will start with whoever looks less embarrassed by my question.
Well, I'll just go back to the thing that I said earlier, which is, let's focus on the financial sector, right? I mean, for me, if we think about is your project bankable if it's not climate resilient, you're on both sides of the ledger there, right? And we're not on both sides of the ledger for this at the moment. We're thinking about opportunities kind of separate from the risk, and I think if you think about, bankability in terms of climate resilience, you might kind of be able to swing both sides.
I think one of the holy grails of blended finance is to try to help create structures that are large enough to attract institutional capital. And I say that partly because then you acquire a whole new bunch of cheerleaders, right? So if that Seychelles deal I described before, what we're financing is them trying to take that deal, replicate it in other heavily indebted nations, and float a blue bond. That would reduce the cost of capital of that kind of approach, but more importantly, perhaps, it gets fully commercial investors in the habit of thinking about things like this as part of a normal investment. And I think when we get there, then we've got a whole class of investors who think about climate, and they think about adaptation, and they think about resilience because they're exposed to transactions and instruments and investment opportunities that have that element. So I would just say that anything that gets institutional capital in the equation has double use.
Having worked on a lot of tower projects in Africa and mobile penetration, I really like leapfrog technologies. And I think there's a real opportunity in infrastructure with resilience, or just to echo what Stacy was saying, we have the opportunity to really introduce the element of what is going to be bankable over a long run in infrastructure into our current assessment of how we're going to look at the bankability of a project. I think that's going to be really exciting in infrastructure to be able to do and to be able to say, and then you'll get to those project finance structures that can really easily tap into a wide source of capital to be able to finance infrastructure. So I think that'd be a really interesting industry to focus on.
Yeah, so it's a tough question. So many things to do, but just thinking, so a lot of work is in developing countries and poor, rural areas, including. So I think, linked to a previous point made by previous panel is access to clean water and safe water. That's the main thing for many parts of the world that they don't have the luxury we have here. So how to bring those kind of technologies to those parts of the world that don't have access to that water. Yeah.
Great. Well, thank you for your answers, and please join me in thanking our panel for a great discussion.
How to summarize what we've been through. What were some of the cross-cutting themes that really surfaced in one guise or another in virtually every panel? And that's something that has been identified in the GARI report that was circulated last November in Marrakesh, and that is that we still lack common metrics, common framings, common ways of wrapping our head around this challenge, whether it's a quantifiable risk or deep uncertainty. Whatever it may be, we still have gaps that currently prohibit the investment world from accurately framing or framing these risks or opportunities in a way that is translatable to the investment community and a lot of the business taxonomy that would normally proceed. If that were not the case, we wouldn't all be here talking about this rather far-reaching transverse risk. So in various ways, I think John Firth said, we haven't been helped by the ongoing framing of this issue in environmental terms, when in fact it's really an economic, financial, political, technological challenge, and should be framed in such ways. And when you look at some of the discussions we had, for example, about agriculture, going back to the first panel, the point was made, and you hear this a lot in agriculture, that resilience is in agriculture often very much first and foremost the function of best practices, of good efficiency, good productivity, and then from that, the process of continual improvement of resilience can proceed. Our work our ongoing work that was presented in Colombia, South Africa, and the Philippines on trying to identify some of the market activity that's coming out of the agricultural sector and the transport sector in those countries, again, suggests that various actors across sectors use different terminology and different framings when discussing opportunities and responses to this transfer risk, but to this transverse risk. But still, we soldier on. In panel 2, the point was made that probably the operational risks from the physical impacts of climate change, which are now very much front and center with major financial institutions like BlackRock and the Bank of England, State Street, and several others, are probably the tip of the iceberg. The real issue, at least in financial institutions, is credit risk and issues of potential correlated risk across portfolios and so forth. And then we had some representatives of large financial institutions and consultancies from Brazil, that one of which manages 2/3 of the agricultural portfolio of that country, who expressed their great interest in trying to come up with a usable tool that would enable them as a financial institution to put in financial terms, to meaningfully frame in financial terms climate risk in that agricultural portfolio, while at the same time putting in financial terms the benefits of greater climate resilience among their client base. Our visitor from Mitsubishi spoke, very impressive what's going on in Japan, kind of an explicit recognition that this is in fact an opportunity, that climate resilience, as difficult as it may be to define, to frame, to operationalize, represents an opportunity for Japanese businesses in a very explicit way. You don't see this in most countries. So a really interesting listing of various climate resilience solutions from various companies, and we're sure that that is probably the tip of the iceberg. The idea that point made by Jay and Lightsmith, the GARI group, that climate risks, weather risks, if you will, have been around since before Hammurabi. These are floods, droughts and so forth, are something that we're used to, but we do have a shift in vector in terms of magnitude, intensity, and perhaps rate of change as well. And that is a game changer. And also the answer to this is not the Esperanto problem of creating new taxonomies, new definitions, although certainly it's a growth industry for those of us who may be leaving the cosseted realms of the multilateral world soon. The point was also made that to date we are unaware of any investment vehicle yet in the world that has as its explicit aims to invest in climate resilience, from whether it's in companies or whether it's in particular projects. The point was also made that money, public sector attempts, NAPs, nationally determined, or NDCs, and some of these large public sector programs are probably, again, coming from an environmental framing and have missed the boat in terms of this as a social, political, and economic and engineering challenge. A legal tsunami, the risks that may come in the future from not having been more explicit about challenges in terms of infrastructure and so forth, the continual building in places like Miami Beach and so forth. We had a representative of a large engineering firm stand up and say they have a liability risk for trying to design to a more resilient state or standard because of a code issue, because of designing beyond code can make them more vulnerable. So this is clearly a risk that in its transverse nature cuts clearly into the legal world as well. I teach occasionally at Georgetown, And I know our Center for Law, one of the biggest growth areas right now is climate law. This is going to be obviously a huge area. Some of the folks that came up from the Collider in Asheville, again, tip of the iceberg perhaps, but what distinguishes them is that they are entrepreneurial, they're trying to come up with new solutions, and it's framed from a very explicit climate resilience perspective. For example, investing in buried lines and the kinds of hidden infrastructure that keep projects and human habitation going, which are extremely climate vulnerable, perhaps are a better investment than things that might appear more obvious, like resilient bridges or dams or what have you. What else? Some very innovative ideas presented in terms of commercial or approaches to real estate, ideas that might have sounded kind of a couple of sigmas from the mean not that long ago, right now cause people to pause. This is not such a crazy idea. Maybe it's not a crazy idea at all. Blended finance, again, an idea that's been a practice that's been around since the East India Company and before. Maybe not a lot of evidence based right now to support this as a modality for promoting resilience, but gentlemen from OPIC certainly amply demonstrated the market failure or the private side failure, if you will, of investing in resilience, in especially emerging markets, given a wide spectrum of risks, real and perceived, on the part of the investment community. So in terms of blended finance, whether it crowds out, whether it's resilience positive or neutral, it is with us and it will continue to be until we can get past the metric and the conceptual gap that we need to traverse before we can begin to frame, before we can really unleash real private capital in this area. That's just a very, very, very quick overview of what everyone said. Jay, would you like to talk about the GARI meeting? You might, and for the people, there might be people here that don't know what that is. You might want to give a little propaganda.
Great, thanks. Just reporting out, the Global Adaptation and Resilience Investment Working Group had a meeting this morning that was very generously hosted here by Steve and the IDB MIF and support from the Nordic Development Fund and Proadapt generally. And that working group consists of over 170 different folks that have participated in a series of discussions looking at the intersection of investment and adaptation and climate resilience. And so following on the publication of a discussion paper that summarized the discussions last year at Marrakesh at COP22 called Bridging the Adaptation Gap, which is on the web at www.garigroup.com, we decided this year to focus on a number of different outputs that should bring this into more of a practical highlight. And so this morning's set of conversations really finalized, I think, our agenda items for 2017. We agreed to move forward in producing a basic investor briefing guide that sort of tries to summarize some of the great work that's been done around metrics, around opportunities, around risk for institutional and other investors that are looking at this issue in resilience or physical climate risk as it may be described for the first time as one of the outputs. And another output to continue to track innovation and development around both the opportunity set and around metrics for investment as well. I think there was also two other major suggestions that came out of the discussions. One was a very strong interest in really looking very concretely now at cost-benefit analysis and return on investment and trying to call for case studies that are already out there and collaboration and work for folks to actually produce that. And I encourage any of you that is interested in this topic to contact us, and we're happy to talk to you about that. And the last piece was an announcement that there will be, we'll probably engage in a formal partnership with the United Nations Secretary General Climate Resilience Initiative, the A2R Anticipate, Absorb, Reshape initiative that's been set up in the COP21 context, which the working group was announced in conjunction with, and I think I'd encourage folks that are interested in this area to look to that as one of the networking nodes that can actually try to encourage this entire area. I just wanted to finalize comments here very briefly by thanking specifically Steve for his leadership here in putting this event together, among other events, the IDB MIF, the Nordic Development Fund, and the broader community of folks here that have come to Washington during this very important and very busy time to have this conversation. I think the progress that's been made in looking at the practical focus on risk here on the one side for resilience and potential for investment on the other has come a very long way in even the 2 years since Paris tried to put adaptation finance on the same level again of priority as the mitigation side of things. And so it's your hard work and engagement here from various different places, and the fact that this conversation continues to progress that I think is going to show progress and will lead, I think, to the deployment of capital in a more intelligent way, the analysis of risk in a more intelligent way, and hopefully a safeguarding and enhancement of the development that I think a lot of the folks in this room are focused on. So thank you very much for your contributions. Thank you again to IDB MIF and the Nordic Development Fund for the great support of Proadapt. I think it is one of the leading initiatives that's out there. We certainly welcome folks to join the Global Adaptation and Resilience Investment Working Group, and anyone who's interested in investing in adaptation and resilience. I'm always happy to talk about this as well. But thank you very much. It's been a really wonderful event. Appreciate it.